Hi, everyone. This is Jason Miracle of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He used to work on Wall Street at Lehman Brothers. He published a book about the collapse of Lehman Brothers. That was his first best-selling book. His other personal finance book, which came out a little over a year ago, maybe a year and a half ago, is No Worries: How to Live a Stress-Free Financial Life. He also has a number of other books on his personal life with meditations and his life as a DJ. Jared Dillian, thank you for joining me again.
Hey, thanks for having me.
And Jared also has his daily Dirt Nap investment newsletter, which has been very popular. You've been publishing that for almost 15 years now.
17 years.
Very, very long time. I remember when it first launched.
Yeah, 2008, long time ago.
So we're recording this interview on Tuesday, July 29th, 2025. I want to get your thoughts on the Federal Reserve Bank keeping interest rates at these levels. Which industries do you think, sectors or industries do you think are having the most problems adapting to interest rates at the current levels?
Well, I would say residential real estate for sure. I mean, just, you know, I don't really have a problem with keeping rates artificially high. I do have a problem with keeping rates artificially low. If you look at the true-inflation numbers, they're a little less than 2%. Let's call it 2%. Fed funds are 4.5%. So we have real interest rates of 2.5%, which is a little bit restrictive. I'm okay having rates that are a little bit restrictive. The S&P is at all-time highs. There's a lot of other stuff that is at all-time highs. The economy seems to be doing fine in spite of 2.5% real interest rates. Should rates be lower? I mean, yeah. I mean, I think real rates should be 1.5%, which means Fed funds should be about 3 to 3.5. I think that's probably where they should be. But the consequences of having rates too high are nowhere near as bad as the consequences of having them too low.
Now, you've also been warning about private equity and private equity experiencing problems. I think you were calling it, over 12 months ago, a bubble that was going to eventually pop. Do you still see that? Or do you think that private equity has managed to figure out maybe how to get lobbying dollars or bailouts or even dump like some private equity investments onto retail investors?
Yeah, I mean, you said it. This thing about private equity being put into 401ks, I actually think that's a pre-bailout of the private equity industry, a pre-bailout. I think that the Trump administration knows that private equity is a bubble. I think it's systemic risk. I think they threw retail investors under the bus by this 401k nonsense. I think that this is there's going to be all kinds of unintended consequences for this. I mean, the private equity business has a ton of undeployed cash as it is. They don't really need more. If you have a private equity fund and you're a 401k, it's not liquid, and theoretically you're locked up for 10 years. So, to the extent that you ever need to tap your 401k and get liquidity for some emergency, you won't be able to. These are stories that are going to be written 3 to 5 years from now. The consequences are really bad. I mean, look, like I think that the industry has found a way to postpone the reckoning for as long as possible. Liquidity always finds a way. There will be a crisis at some point. The bigger private equity firms, the publicly traded ones, are probably best positioned to weather the storm. But I think there's 17,000 private equity firms in the U.S. A lot of middle market ones, a lot of smaller ones. Most of these are going to go out of business at some point in the next few years.
Did they buy bad businesses at bad valuations where there was no cash flow, or do you think like they use debt at bad interest rates? What do you think it is?
Well, I don't think all the businesses are necessarily bad. I think there's a lot of good businesses out there, but the valuations are too high. Private equity made sense like in 2015 when you could buy a business at 4 or 5 times cash flow, and interest rates were zero, right? That made a lot of sense. With interest rates at 4.5% in Fed funds, or 7% in mortgages, and you're talking about buying a business for 12 times. Like that makes no sense. I mean, that business doesn't work. And yet there, and not to mention the fact that exits are down. There's no IPOs. I don't know. There's been a lot written about zombie PE firms and stuff like that. Like this is, it was over a year ago that I got bearish on private equity. It was actually in December of 2023. So this is, and I've been expressing that through puts on some of the publicly traded private equity firms. I've lost some money on that. I plan to stick with the trade. Out of the universe of everything I could possibly short, that still to me is the best short on the board.
Are they also invested in like the Silicon Valley unicorn companies like WeWork and then overexposure to commercial real estate, which is not doing well either?
Yeah, I mean, Blackstone in particular has a big exposure to real estate. The funny thing about Blackstone is that they actually have a higher exposure to real estate than they do to private equity. It's mostly a real estate firm. Um, and that, I'm not a super bear on commercial real estate. I think commercial real estate is actually going to be okay. There's I really the whole basis for this trade is that after the pandemic, people weren't returning to offices. People didn't need to commute; they could work virtually. Why do we need all this office space? Um, that sort of that trade sort of bottomed about a year and a half, 2 years ago. People are returning to offices. They'll continue to return to offices. I'm not super bared up on commercial real estate.
Well, people will turn to offices if there's full-time jobs, but now we're starting to see what these big technology companies, even though they have record profits, are starting to do mass firings of computer programmers and salespeople, which is kind of surprising, and even HR people. Those jobs are also being automated.
Well, I mean, one of the things about the tech industry, I mean, tech in general is bloated and inefficient and corrupt and hired too many people. Google has 185,000 employees. They could run that business with 10,000 employees. Um, Sometimes the tech firms hire people just so they won't be hired by a competitor. You have a lot of people in the tech industry who get paid $300,000 a year and don't really do anything at all. It's an inefficiency on a scale that we've never seen before. So I think if we ever really had a bear market in tech, which I mean, I guess is possible, but given the last 15 years, doesn't seem likely. But if we did, you would see layoffs in the tech industry. Let me put it this way: you would see the unemployment rate go up very quickly. There's a lot of people that are not adding value.
Well, Mag 7 has outperformed the S&P 493, so the majority of the outperformance in the index has been solely from the Mag 7.
Yeah, that's true. That's true.
So you think then that there won't be mass firings then from artificial intelligence software or humanoid robots? You think then that that's overblown?
I don't think it's necessarily overblown. It's funny when ChatGPT first started 2.5 years ago, everybody jumped to all these conclusions that all these jobs are going to be lost. We need universal basic income and all this stuff. And the only thing I really caution people is that, these things take a really, really long time to play out. It's been 2.5 years now, and we're just starting to see some job losses due to AI. I've been reading some things recently about how, investment banking analysts, the spreadsheet work that they do will essentially become redundant. You'll need less people working in investment banking. Multiply that times a bunch of I mean, the legal business, like all sorts of places. So it is going to happen, but it's just slow. It just takes a really, really long time.
I want to ask you about bond yields and inflation. Do you think the weak dollar is helping to boost asset prices in spite of maybe some of the other problems in the global economy?
Well, first of all, I think the dollar is done being weak. I think it turned yesterday with the announcement of the EU trade deal. I think positioning in the dollar has gotten very overextended, very bearish. Sentiment has gotten very bearish on the dollar. I think the dollar is going to have about a 4 to 6% correction higher, which is going to catch a lot of people off guard. It was funny. I saw Mohammed El Arian tweet last week. He posted a chart of the dollar and he said something to the effect of, I don't see what turns this around. And of course, anytime somebody in a position like him, like anytime somebody says that, that's the moment that the trade does turn around. Do I think that the weak dollar has been affecting valuations? Um, I mean, there's a couple ways to look at it. First of all, like if you're an investor someplace else in the world, if you're a investor or an Asian investor and you're buying U.S. stocks, I mean, basically, you just took a 10% hit from the currency year to date, and generally over long time periods, equity returns and currency returns are correlated. So I actually don't think that the weak dollar has helped valuations. I think it's probably hurt it a little bit, but we'll see.
Do you think that President Trump and his Treasury Secretary Scott Bessent that they want a weak dollar, and so even though they're talking about U.S. dollar strength, U.S. economy strength, no inflation, that they actually their real policy intentions they want the dollar devalued to bring back manufacturing jobs and capital investment into the United States?
100%. I absolutely believe that's the case. In fact, I think I saw a video with Trump the other day. Trump actually said that explicitly the other day. He was speaking to some reporters and he was talking about having a weak dollar. I definitely think that's their goal. So
I was listening to an interview with Mark Andreessen, the tech billionaire, and I think unfortunately the PayPal mafia is deciding a lot of the policies now, especially tech policies here in the United States. But Mark Andreessen was talking about President McKinley over 100 years ago, and basically McKinley was doing the similar tariff policy to what Trump does. It was like shock and awe with like 50% or higher tariffs, and the goal was to get the other country to the negotiating table to get the tariffs down then.
yeah, I'm a very bad historian. I don't know that. I know Trump is a big fan of McKinley, and I think he would like to get to a place where the U.S. government is funded by tariffs and not income taxes, which is where we were in the late 1800s. Um, I'm not sure that's entirely possible, but Trump also, like, I mean, we're allegedly collecting some revenue on these tariffs right now. We've collected like 50 or 100 billion in revenue. Um, he's talked about having tariff rebate checks to people of a quote certain income. So this is just rank populism, right? Like, so we're running a $2 trillion deficit. We find 100 billion in our pockets from these tariffs, and we immediately give out checks to low income people. Like, this is this is not how to run a country.
Yeah, it's picking and choosing winners and losers, or whoever's spending the most dollars on lobbying to Congress or other special interest groups with political campaign contributions. But in terms of like who the tariffs are hurting, I mean, it's hurting small business, it's hurting the consumer who doesn't have a ton of discretionary income or a high salary, and then it seems, Jared, that a lot of these corporations are getting exemptions from the tariffs.
Yeah, exemptions from the tariffs and also exemptions from deportations. I mean, not to get too much into politics, but we have this anti-immigration policy, and we're deporting people back to their home countries. But some of the big hospitality firms, hotels and restaurants and stuff, are looking to get exemptions from these deportations and the tariffs. Like Apple has basically been exempt from the tariffs because if we did have tariffs, if Apple did have them, then we'd have $3,000 iPhones, and we just can't tolerate that pain.
Do you think a lot of the policies that we're seeing, whether it's the tariffs or China retaliating with rare earth export bans or other export bans on rare earth in the value chain, do you think it's an escalating kind of Cold War 2.0 between the US and China and a technology arms race?
I don't know that I would go that far. I mean, we're gonna find out more about China pretty soon with regard to the tariff rates. Um, yeah, I don't know. I can't really say.
It's just shocking, like some of the stuff, like the 50% tariff on copper. I mean, that came out of nowhere. The copper prices stayed high because I think the market wants to see more copper supply in the United States come online before the copper price comes back down. It's just kind of surprising all the policy announcements, especially with commodities.
Yeah, out of all the tariffs, the tariff on copper makes the least amount of sense. Um, like, I mean, allegedly, the goal of the tariffs is to reshore jobs and manufacturing back to the US economy. And like, do we really want copper mines in the US? Like, I don't know about you, but I'm perfectly content to have them in the Congo. Like, copper mines are, environmentally destructive and it's a dirty business. Like, why do we want copper mines here? Also, it takes 20 years to start a new copper mine. So we're essentially, paying a 50% tariff on copper for no reason. Like, that was a real head scratcher for me.
Well, they can eventually automate these copper mines. So we're starting to see some of the new mines that are built now in South Africa. Like there's a platinum, massive copper and platinum mine that's coming online soon called Platreef, and most of the mine's going to be automated. So maybe we'll see that in the not too distant future. I mean, they're talking about that with factories, that they're going to start automating with humanoid robots and a lot of automation for factories too, in addition to mining.
Didn't know that. Thanks.
Well, I think that will the issues with Africa, what is that there's a lot of child labor involved in a lot of those African mines, so it's like not in my backyard, and they're cutting corners environmentally. China, when they mine, is cutting corners environmentally. Same thing in Africa.
Yeah, that's for sure. Yeah.
That's the issue with the whole rare earth thing, Jared, is that like one of the reasons China got the monopoly is basically they destroyed the air, water, and soil all around the rare earth mine, and that's the reason why they were the low cost producer is they skirted all the environmental responsibilities.
Yeah, I mean, that's another reason why, look, like the US has copper. Like I read recently that we have a large copper deposit in Arizona. But under our regulatory framework, like it's too expensive to have a copper mine to comply with these regulations. Where it's much less expensive to do it in some corner of the world that doesn't have these regulations. So,
Yeah, I agree. It could they could bring on a mine in 5 years or less in some of these countries, whereas here in the United States it could take a decade or more.
yep.
I want to ask you about bond yields. So, do you think then that President Trump and Bessent, you think they wanted bond yields on longer duration U.S. Treasuries lower, and are they surprised that they're not getting lower bond yields?
Yeah, I mean, if you go back a couple of months ago, when you essentially had the rest of the world selling U.S. Treasuries in response to the tariffs. That was back around Liberation Day, and yields shot up. I don't, Bessent's a smart guy, by all accounts. I don't think he foresaw that. Bessent wants long rates to come down so he can term out the debt. They haven't come down; they've actually gone up. What are they going to do in the future? I'm actually a little bit bullish on bonds. I think rates are going to come down. I think the consensus that the deficit is intractable and we're going to have this massive supply of bonds and rates are going to shoot up and we're going to be insolvent. I think that's a lot of hyperventilating. Once again, this is a situation where that probably will happen, but it just takes a lot longer than people think.
Well, can't they cap the yields with financial repression and yield curve control, or what is it, fiscal dominance or debt money? All those different names are basically more or less the same thing. They could do something like that along those lines to try to cap the bond yields.
Yeah, I mean, I think we might see that in Trump's term. We might see that before 2028, depending on what happens to the bond market. If 10-year yields go up to 5.5%, you might see some chatter about that. It is possible. I think that is kind of the end game anyway, regardless of how long it takes, whether it's 3 years or 10 years or 20 years. I think we're going to get to that point. And if it does, that's the point where gold goes parabolic.
Well, it's kind of already gone parabolic. It was going parabolic in a lot of other currencies before the US dollar gold price, but we've had a huge gap up the last 18 months in the gold price because it could barely stay above 2000. And then it seems to what got into 2200. It was there in a range for a little bit for 6 months or something. It dipped back down and then it took off again.
Yeah, it's in a range right now. It's been in a range for the last 4 or 5 months. It's been consolidating, and I'm still super bullish on gold. I own a lot of it. I think I think we're not going to break out of this range to the downside. I think we're going to break out to the upside, and it's just a question of when.
Well, I think what DC doesn't understand is that every time that they say they're going to put huge sanctions on a country like Russia or another country, that the holders of U.S. Treasury, say Japan or some of these other countries that own a lot of treasuries, they start to get fearful and they want to dump more treasuries. So Trump today, he just said that if in 10 days, I think he said he's going to increase sanctions again on Russia. And 3 years ago, that's what started the huge move in the gold price were the sanctions that they put on Russia.
Yeah, and actually, China has been buying a lot of gold for the last year or two, and there's some speculation that China saw what happened to Russia with the sanctions and is accumulating gold. In preparation for a day when they possibly invade Taiwan, and they're shut out of the financial system like Russia. So I think there's a chance that they're accumulating gold in advance of that. I think that's definitely a possibility.
Well, they're also accumulating copper. I mean, they've been accumulating natural resources in Asia, excuse me, in Africa and Latin America for many, many years.
Yeah.
I mean, they were doing what? Debt diplomacy, right? So they'd go to these African countries, these poor African countries or Latin American countries, and they'd give them way too much debt. And then they'd end up getting a copper mine or a port or an oil, huge amount of oil and natural gas deposits.
Yep, yep. I saw that happening in East Africa. Yep.
So in terms of capital allocation now, looking for asset classes that are cheap, hated, good value, you're saying that treasury bonds you think could rally?
Yeah, that's kind of low conviction. I think there's going to come a time when value makes a lot of sense. And people have been saying that for 21 years, but I don't think it's going to be another 21 years. I think there's going to be some kind of factor shift sometime soon. Um, Really, I don't know what the catalyst is going to be to deconcentrate the S&P, from where seven stocks or 35% of the S&P into something more equal weight, where small cap and value do better. But I think we're pretty close to that happening sometime soon.
From a contrarian standpoint, I mean, I think oil and natural gas companies, like they're going through restructuring with BP. BP was a mess. They were losing billions of dollars a year for the last 20, 25 years on wind, solar, biofuels, all these ESG investments. They're finally restructuring the company. They're getting rid of all the negative return on investment stuff there in the green energy. So I think oil and natural gas is cheap and hated. And then you add in what all these data centers that all the technology companies Russia is going to start building data centers, United Arab Emirates because they have cheap natural gas. So I think like the energy play is kind of the undervalued way to play the tech play, all the investment that big tech is making.
I would agree with that. Yeah, for sure.
Yeah, so I think oil and natural gas. I mean, Canada just brought on a really large oil and natural gas pipeline. They set up a liquefied natural gas export facility. I don't think the market has priced those things in yet. So I think there's a lot of investment that's going to be needed in order for this next technology cycle, all the capital expenditure.
Yep.
Yeah, so as a contrarian, I'm just looking around for what's cheap and hated right now because what a couple years ago, platinum and palladium was out of favor, the gold stocks, and now what the gold stocks have enormous free cash flow growth compared to a lot of the other industries.
Yeah, and also it's funny you bring up platinum and palladium. I think platinum in particular just got to a point where it was too cheap relative to gold. And there are some substitution effects, like, even at a very small scale, if you're a jewelry manufacturer and gold is 3,300 an ounce and platinum is 1,000 an ounce, like it just makes more stuff to make stuff out of platinum. So there are some substitution effects. I think platinum in particular is going to catch up a lot relative to gold. It broke out of a multi-year downtrend. The technicals are great. It's consolidating around the highs. Like I'm super bullish on it.
And also on the supply side, to add to your points there, I mean, a lot of platinum and palladium miners were losing enormous amounts of money the last couple of years during the bear market. I mean, there were just article after article, a platinum and palladium miner in South Africa that their profit margins were enormously negative. So I mean, that was clearly not sustainable. Trying to pick the exact bottom in the platinum market was difficult, but it was obvious that it was not sustainable for all the producers just to lose money hand over fist.
Yep.
So a mean reversion, and then I think you said on the demand side, it was the jewelers, but also like my contacts in China, like in Shenzhen and Hong Kong, a lot of people that would normally just buy gold coins and bars, they started allocating a little bit of the capital into platinum, palladium, and silver. So they noticed those metal ratios, like you said, and then instead of just buying gold because the price of gold had already gone up and the premiums were higher, they started allocating a little bit of capital into the other metals.
Yeah, makes perfect sense. Makes perfect sense.
So, do you think then that like these five or six technologies like drones and quantum computing, robotics, artificial intelligence software, are these in long-term bull markets right now?
Well, when I hear people talk about quantum computing, I guess there's some quantum computing stocks. I haven't really looked at them. Like, I'm very skeptical that when you talk about these technologies, robotics, quantum computing, that the companies that represent these sectors are going to be the ones that are successful 5, 10, 15 years from now. Um, I remember when Bitcoin really took off in 2017 and people came out with all these blockchain ETFs and they were really spurious. And a lot of the companies in these blockchain ETFs went to zero or did nothing. I just like I'm just very skeptical that I don't even know any of these tickers off the top of my head, but I don't think these are going to be the way to play these technologies over the next 10 or 20 years.
Yeah, I agree. Quantum computing has a ways. They have to spend a lot of money, capital expenditure, and research and development. It's mostly the U.S. military and big tech companies like Microsoft and Google and Palantir that can actually invest the capital to actually develop quantum computing. And we're still at least like 5 to 10 years away, I would say.
Yep, exactly.
But do you think also that Nvidia, which has clear market share, you think they could even lose a lot of their advantages then in 5 to 10 years?
Oh my God. Yeah, absolutely. Um, Nvidia has a pretty good head start. But this is it's funny. I have an analyst that works with me, and he loves to find businesses that have a moat. I would say Nvidia has a head start, but it does not have a moat. It does not have a durable competitive advantage. I mean, I think that's reflected in the volatility of the stock. I mean, the stock is like a 50 or 60 vol or something like that. Um, it's a 4 trillion market cap. I have a tough time buying that stock at these levels. So,
Well, I mean, China, what is copying Huawei is supposedly making huge strides towards a similar chip to Nvidia. So that would start to get a lot of sales away. And then what the BRICS countries, so Russia and some of the other BRICS countries are not going to be buying Nvidia chips then. I think that's why the Nvidia export license was approved because they realized Huawei's catching up so quickly and they wanted Nvidia to get some more sales before Huawei starts selling their chips.
yeah, that makes sense. That makes sense. I didn't know that.
Yeah, that was my educated guess here, just seeing how things play out. That Nvidia wanted to extract some more profits before Huawei's chip, because I heard Huawei's closed the gap pretty quickly. I mean, we're starting to see whether it's DeepSeek. I mean, the Chinese software innovation is fantastic here on the artificial intelligence side. It seems like every time the U.S. launches like some new software with Google or XAI, that a month or two later there's a Chinese copycat that's a fraction of the price.
Yep.
So it's a very interesting time. I honestly think, Jared, that this artificial intelligence software, and you were around during the tech bubble, do you think that the companies that are going to benefit the most are going to be companies in other industries that take the software that gets better and cheaper every 6 months or 12 months, and they're going to adapt to it? They're going to cut their overhead. So, like, it's going to be in finance, maybe a cheaper Bloomberg terminal instead of $29,000 a year for a lease, or in legal with getting rid of paralegal employees. Do you think then it's going to benefit businesses in other industries rather than tech companies?
Rather than tech companies, I mean, I think tech companies are going to benefit. I got to be honest with you. I don't spend a lot of time thinking about this. I'm a macro trader. I trade FX, I trade rates, I trade stocks, I trade commodities. Like, I don't, I'm not, I'm about as far away from AI as you can possibly get. So I just haven't devoted any brain power to this.
Well, you have a Bloomberg terminal, and I mean, like, I'm sure you're paying the least for that. They're obviously with artificial intelligence of our new Perplexity's working on a better and cheaper alternative at a fraction of the price.
Perplexity is working on a cheaper alternative to Bloomberg.
To a Bloomberg terminal, yes, they're working on it now.
Interesting. I didn't know that.
They actually just launched for Perplexity Pro. They can pull all the data for securities and exchange filings for a fraction of the price of Yahoo Finance Pro. So they're working on integrating the cash flow modeling, I think, into Microsoft Excel too with the command prompts.
Wow, I didn't know any of this.
Yeah,
Interesting.
they're working on this right now. So they're working on helping accountants and CPAs and tax professionals and cash flow modeling. Yeah, so that's coming, I would say, in the next 6 to 12 months.
Well, I'm going to have to write a check to Bloomberg in about 2 weeks. So, from your lips to God's ears.
Well, I mean, like for finance, that's considered one of the largest moats, and it looks like in a couple years that could be in jeopardy.
Yep. Yep.
Well, I want to thank you so much for your time today. Please tell my listeners more about some of your new books, especially your personal finance books, since this is an investing podcast, but also your other books.
Sure. So first of all, you can find me on Twitter at Daily Dirt Nap. My website is jareddillianmoney.com. All my newsletters are there. You can find me there. No Worries, How to Live a Stress-Free Financial Life is my personal finance book. Uh, I can't recommend it enough. It's a very good book. And my most recent book is called Rule 62 Meditations on Success and Spirituality. And it's an essay collection on success and spirituality.